All right, well, welcome to the Boring Millionaire. My name is James Lamantia,
I'm Nick Polari.
and we are the Boring Millionaires. So today we're going to go over how you make the real money in the stock market. So over the past week, the markets have been in decline, fell only 4.5% off its all-time high. So the discount is there. We're not really in disaster territory. However, the market is falling. And when it falls like this, it does nothing but present opportunities to reposition yourself in the companies we're already invested in, build stronger positions in those companies, and look around and find everything else that we may be interested in new in the market. So over the past 4 months that we've had the podcast, we've been trading in the same range between 58.50 and 61.44 is the all-time high. So that is typically how the market just moves and reacts to everything. It stays in a stagnant range. It kind of just balances itself out. And then as news enters the market, exits the market, buyers and sellers have that information to basically make their decisions with that information. So over this past week, we've been seeing the sellers take a stronger hand. We somewhat anticipated that, this could even happen, but we're in the down now, and signals are showing that we're probably close to the bottom, and it's the moment that we should be buying and putting money into the stock market.
Yeah, I do want to touch on something you said. It is the perfect time, and I know this is how I've adjusted my strategy as stuff has been falling. It's just rebuying stuff I already have to bring the cost down. As a lot of my $50 lists and a lot of my buy and hold strategy on my other account has just pretty much been that. I'm in at a certain point. It's fallen, like you said, some news. There's been some bad news in the market this week, so I think that's more why we're down. But as that's been going, I've just been buying to bring the cost down to just have a better position. So, when everything turns around, when a lot of the uncertainty leaves the market and it starts to raise again, I can have a better position to make money off of.
Yeah, you're absolutely right. You're strengthening that position and you're strengthening your core stocks that you have and hold in your portfolio. And it's moments like this where I love to buy the Mega 7. I love to buy my core stocks, what I love in my portfolio, because it's the same assets that I love to hold and love to invest in, just at a cheaper discount, essentially. I'm already making the same moves, just getting into them at a cheaper value. I just want to also say, too, looking at the NASDAQ and the S&P 500, the two major indexes, they're positioning themselves where, although we've seen the decline and the roughness is in already, everything's pointing to the fact that we're probably at the bottom for this. So we see the S&P 500 just about 1.5% above its 1-year average. The NASDAQ had fallen to that 1-year average. So those points are where we like to see the market rebalance when we see these declines. We were talking earlier about the volatility index, the VIX. So that has not broken past 22.5 today. If it were to go over 22.5, a little bit more of a danger zone, a little bit more, to worry about. But we're not breaking through. So to me, that's a sign of strength. We're not over panicked, we're maintaining the animosity.
We're pretty much where we're at before the election. So
Exactly.
It's not like we're really in bad territory. I feel like a lot of the election brought us up to where we were. I think a lot of people had a lot of anticipations for certain things, and I feel like that's what really drove the market. So to just kind of fall back, I think it's just kind of correcting itself a little bit, and some of the hype's out.
Exactly, yeah. And I think it's an important point to raise is that it's a trading range. So after the election, it was a major market news, and we ran into record highs. But since then, for these past 4 months, essentially, it's just been back and forth in that same range. So in theory, if we started at 58.50, that was the low, we are at the lows now of this range. So just as much of a good opportunity it was to buy projecting into record highs, it's just as much a good opportunity because the discount is here. We know that we could reach these higher values, and then when we further break into higher all-time highs, there's a premium that is appreciated on those investments. So I'm a buyer of everything that I've been looking at. We would love to see the market go up as opposed to down, but these down days and down weeks are what actually makes the market. So in many episodes prior, we always talk about buying stocks at their 1-year average. The market of stocks needs to rebalance and go to that 1-year average. And that's all we're seeing right now.
Yeah. And I think it is also perfect for, some of these negative moments because a lot of people, I know myself included, you get that feeling of missing out. You get that feeling like I should have made a move. I should have done this. I should have done that. Well, this is the time to do it. This is the time to take that opportunity. Anything you miss, this is the time to pick it up.
Absolutely. And you took the words right out of my mouth, essentially, because I'm taking the opportunity, even though I've been involved in the market for 11 years and have held these positions for just about that whole time, I don't want to miss out on the opportunity to buy my favorite stocks at these lower positions. So this is not my $50 list, but I know I'm buying Alphabet, Amazon, Apple, Nvidia, Microsoft, even fall into the B tiers like our Home Depots, our McDonald's, Visa, MasterCard, Bank of America, Morgan Stanley. All of the blue chip stocks that will build a portfolio and build a nest egg are all at discounts. There's a lot of opportunity out there to be taken advantage of.
Yeah, it is perfect. And I know we always like to praise the Mega 7. That is pretty much the driving force of the market. A lot of people look to that because they are the 7 biggest companies in the market. So to get them at such good prices, it's a steal. Especially too, I feel like they're going to take a lot of the hit because I feel a lot of the money is in those companies. So I think they are going to be the first ones to kind of fall hard. And then, like you said, the B tiers are going to fall kind of behind. But I think just looking at, like Apple or Google, Microsoft, and I think they are going to get hit a little harder than most other stocks in the market. So there's not a lot of fear there, but I think there is a lot of opportunity.
There absolutely is. And you raise a very valuable point because even in the weekly decline that we saw, a lot of the damage came from stocks like Amazon and Alphabet, who Alphabet is under their 1-year average, Microsoft is under their 1-year average, Apple had fallen to its 6-month average, so they were bleeding out. And another valuable point as to why that's the case is if people are investing in broad index funds that invest in the S&P 500 or the NASDAQ, that is just money into the fund, and then that fund puts the money right into that company. So that is also why a lot of these companies are, I don't want to say the word over leveraged, but have much more of a market cap than many other stocks, is because there is direct funding into these companies via the index funds. So I think if people, just in a general sense, they're not looking at Amazons or Apples, they just look at the stock market and say, we're at all-time highs, we're at the top, I want to liquidate, some of my retirement fund because it's not only 20 and 30-year-olds, it's also 60 and 70-year-olds. So where a 65-year-old might say we're at all-time highs, let me liquidate my SPY, which is a S&P 500 ETF, that money is coming out of stocks like Apple and Amazon. Whereas there's another buyer's market of people who might be younger, whatever age it is, there's people who are incentivized to buy in these opportunities. So money goes in, money goes out, but a lot of the index fund funding is why we see, I think, a lot of the damage in those bigger stocks.
Another thing bringing up index funds, though, they're also a really safe opportunity in these moments. Okay, you don't want to take the risk on individual stocks. Whenever the S&P gets beat up, I know I always like to put my money in because now you're getting the whole market at a discount, at a cheaper price. So indexes are always good to look to at these moments. They're always good just in general because, again, it is building foundation. It's building the safety. It's building the structure of what you're trying to build in your portfolio. And there really is no better way to really play the market than getting some index funds to really just have your safety, your net,
Absolutely. You raise an incredibly valuable and resourceful point. The index funds are the foundations of our portfolios. I could speak for myself, and I know what you invest in, but we like that as a backboard foundation to everything we're investing in. You're investing in the market, and the one that we particularly love is the UPRO. So you're investing in the S&P 500 general stock market, but it moves at double weight. So this week, it fell twice as hard as the S&P 500 had, but if you're investing in it this week and we see a rally next week, that rally will benefit you twice as much as it otherwise would. So again, it's not on my $50 list, but I am buying the UPRO in a moment like this. Any opportunity like this, I would be a buyer of the UPRO. And I just want to say, to the point you had mentioned, if you're a little more timid about stock picking or actually investing in individual stocks, whether you're choosing on your own or following our guide, investing in the SPY S&P 500 fund or the UPRO S&P 500 fund, whenever the market is down, will certainly build you a nest egg of comfortability over the time.
And I do want to make one more point since we're on the topic of just the S&P indexes. It is, I do like to say the safety of it. I think a lot more of the boring route would be to go into the index funds. But you really have to weigh, there's the risk and the reward. I know we've talked about. So buying the individual stocks is more of the risk, as to where buying the index funds is less risk but less reward. So that's why you want to diversify. You don't only want to buy index funds. You want to spread it out. So you have the foundation, the safety, the lower risk, and then you have the little more risky, but more rewarding by buying individual shares. I mean, you get more of the pieces of the dividends. So you really want to balance your portfolio.
And balance is the perfect word, because when you're investing in an index fund, you are getting a blanket investment on the companies in the S&P 500. So when you're investing in individual stocks, some may participate a little less, some may participate a little more. So when you're investing correctly individually, you could find the benefit from a good buy signal. But when you invest in an index fund, if stocks are falling, that fund isn't going to fall as hard because the balance is there among all 500 stocks in the S&P 500. So a great benefit to having an index fund in your portfolio.
Yeah, so that's why I always like to hold it. That's why I always like to buy in these opportunities. So there has been a little bit of negative news, which really brings uncertainty in the market, and uncertainty is not a good thing because people are afraid they're going to lose money. So that's also why we can see the VIX raising, some sell-off throughout the week, and why it's just kind of been overall red. The jobless claims came up a little higher than expected. So, there's creating fear there. The inflation rose about 0.3% of where we were, which we're only at 3%. So we're only a point over where the Fed really wants to be. So I don't think that's too concerning. But to see it go up, I think people get scared just because they think it could keep going up.
Despite it going up, though, it is in line with the trajectory that the Fed had basically anticipated following their cuts. So nobody likes any inflation, but it is at least in a slowing rate. It might be up 0.3%, but it's not up 0.7% like they may have anticipated. So it is increasing, but increasing at a slower rate. So positive news all around. And the jobless claims, so we had a little bit higher of a number than we expected, but it really is directly coming from the Doge cuts that we're seeing in federal jobs. So I'm not saying it's right, wrong, or indifferent, but what I am saying is it's not a major economic deficit in jobs. It's coming from one particular instance. It adds uncertainty, like you said. We've even mentioned in previous episodes, institutional investors, they don't like to pull the trigger ahead of major market news or when there is uncertainty in the market. But this uncertainty is coming from almost good economic news, really.
And also, too, just one last point to touch on, too. I think a lot of people are afraid because the Trump tariffs are taking place, 25% on Canada, 25% on Mexico, and they're adding 10 to China. They're going to take place on March 4th. So I think people just don't really know what's going to come of that. They anticipate a trade war. They don't know the repercussions. A lot of people have a lot of different ideas on how this can play. So I think a lot of people are taking their money out and they're going to put it in safe options. I mean, people might buy, bonds because they're government backed, but I have my problems with bonds, why I don't really like them. I'll get into that a different day, but they'll put them in bonds just as a safe, slow grind so they don't lose any money. But I'm not really scared. I mean, once everything blows over, once we see kind of just how this all plays out, I think we will be at good standing again. And again, we're hitting bad news. I know Buffett also sold off all of his Spider and his Vanguard S&P index fund. So I think there's just too much uncertainty and fear. So I think that's really just why the market's moving the way it is.
Yeah, it is. It's just uncertainty. It's just rebalancing, and it's kind of just the shift in economics. So March 4th, the tariffs will kick off, but I think, as we've even said in previous episodes, they might be in place. They might be a hindrance for the time being, but I do think they're primarily negotiation tools, and they will in turn be lifted or renegotiated to even have actual value coming in from the tariff, or there's other caveats to it. But I don't think that's going to really get in our way indefinitely for the years to come. Other bad news that we saw in the market was Nvidia earnings. They just did not perform well after the earnings came out, and they had fallen back to their 1-year average, which is roughly around 120. So, just repositioning in a spot we've seen it before. No big deal. Just another entry point that we've seen before.
One of the Mega 7s getting beat up a little bit. And as we were saying, how Amazon just had a little bit of weak guidance on their first quarter. That's going to scare people. A lot of the Microsoft and their cloud services not meeting expectations. It's just creating fear. It's just creating the uncertainty. And like I said, people are just going to take their money and put it somewhere where they know it's safe because they don't want to lose.
Yeah, and I do want to just touch on one point. We could really elaborate on bonds at another time, but simply said, the ultra rich are the people who benefit from bonds. If you take $1 billion and you're getting 5% a year on a bond, that's 50 million every year. So I mean, somebody like that is where they could utilize bonds. But people who are investing even 100K, 5% of that is $5,000 every year. So nothing to sneeze at, but I feel you could operate that money much, much more efficiently investing in stocks as opposed to holding bonds.
My only problem with bonds is the longer that you're involved in a bond, you're pretty much set at a set amount of money you're going to get at the end of the time frame. So even as inflation's at 2, it goes to 3, or even as we saw, it has jumped to 9%, you're stuck pretty much in that area of the money you're getting back. So now the value of the dollar or the value of your buying power has gone down. So now you're actually making less money on the investment you made, as to where in the stock market, it's all relative around the dollar value now. So it'll incorporate where inflation's going. So it takes into account that. So if I buy Apple at $200 and then it goes, to $250, my money is still kind of the same there, as to where if I'm buying a bond and the inflation's hitting it, now I'm getting less money back. So I don't really like bonds for
It's
that.
an incredibly interesting point, and I must say, I've never really thought of it that way. You raise an incredibly valuable thought process with that, because in that example you used, Apple going from 200 to 250 is a 25% gain. If you have a 5% yield on a 5-year bond, it's 25%. Whereas Apple, that move could be made in 3 weeks as opposed to a 5-year hold on a bond.
Yeah.
That's very thoughtful.
Yeah. So I do, like I said, bonds are safe, but as time goes on, you don't know what's going to happen. And as we've seen rampant inflation, it cuts back the buying power that you have on your money. I don't like bonds for that point, but I get why, if you could dump millions of dollars into one.
Right, if you had a bee sitting around, then you were going to just get your extra 50 million a year. We don't buy bonds, that's very clear. So what we do buy is stocks, and we both have our $50 list constructed this week. So with your $50, what are you planning on buying?
So pretty much, again, just saying, I want to rebuild on a lot, because as we've fallen, there's opportunity here. So not really a surprise, I'm picking up some more Amazon, because why wouldn't you? PayPal has also fallen a little bit, so might as well cheapen up where I got in. Netflix has fallen, but I think they were doing great. They killed earnings, so I don't think there's anything to worry about. And I'm not really shortening the cost on it, because I'm around exactly where I bought in. But why wouldn't I buy in more when it was, over 1,000? Now it's back down to 970. I got it 969. Why wouldn't I get it now? So I'm gonna grab some Netflix. Google is still getting a little beat up, so obviously I'm gonna rebuild the position there, because I do love Google. And the last one, because we were talking about it, and because the S&P is getting a little beat up, I'm going to take the U Pro just to build the foundation.
Exactly. That's a beautiful list. I love it. Alphabet is my all-time favorite stock, basically. I would buy it into the gates of hell. So, I mean, no price is too low for me. But my 50, I'm going to take that $50. I'm going to break it up into $5, $10. And the first stock I'm going to pick is Morgan Stanley. So Morgan Stanley is a banking firm, an investment firm, and their range is between the 50-day and the 100-day moving average, which is actually the 3 and 6 month average. So the fact that it's fallen in between the two of them, bouncing around, tells me it's a good position to buy. It's not going to fall under that 6 month average. Next, I have Apple. It's $236 today, and it's sitting also at its 6 month average. It originally fell lower the last time it fell to around 225, did a double bottom there, rallied up. We're hitting a new low, so I think it's just a perfect opportunity for Apple. Next, I have Meta. Very simple. It was just in rally mode. It was really killing it. Just cooling off, just taking a little bit of a breather. So within that breather, it's meeting its 3 month average. Again, love the averages, so I'm buying it there. Next, I have Nvidia. I know I touched on it previously, but after all the DeepSeek news, it fell to 120, which was its 1 year average. Rallied for a little bit, but has since, again, after bad earnings, fallen again a little under its 1 year average, because the average does move, but it is again at 120. So that is a perfect signal for me to buy that stock. I love it, absolutely going in on that. And then Tesla is my final pick for this $50 week. So it's 282 right now. It fell right down to its 1 year average, and it's just been hanging out there. So I think it's an opportunity to buy it. Tesla is a grade A stock. You can't go wrong with it. And, I'm a believer in Elon as well. So I like to be involved in what he's doing as well as what that company is doing.
No, yeah, I do agree with that. I mean, I know I've picked Tesla a lot. I will definitely pick it in the future because, especially right now, since it's where it's at, it's just going to take a lot of time to really even itself out and for the market to go back. But this really is the time to get in. This is the time to reposition. This is the time to buy these stocks. I mean, even going back to Tesla, I agree with that. I wish there was like a SpaceX too. I'd invest in that. It's just and Neuralink, all that crazy stuff. But it is a great stock to be involved in, and like I was saying, it shot right up. It was around, I think, like 225, and then it shot to almost 400. So now that it's fallen, it's really the perfect time to get in. It's a perfect time to get your piece of the pie. So I do love Tesla. You can't ever go wrong with Apple. I love Apple as a company. That's another one not going anywhere. I think they're like one of the only $1 trillion companies right now, just because everything's getting beat up so bad. So, but it's killing it. So it's a great company.
Yeah, and Tesla's a good example of how a move could look super awful, but then when you just zoom out on the graphs, it doesn't look so much as awful, because you even just said all of its price movements started at 225 before the election, ran to 400, now fell to 285. So 400 to 285 seems like immense, but 225 to 285 is a fair return. So where's your entry point? Where's your exit point? But now is the time to find these entry points and to be buying all of these stocks that we had mentioned. So with all of that, it's never been easier to buy stocks. All you need to do is download an app like Schwab or Robinhood. You sync up your bank account. You could take a picture of your checks and deposit it right to the account that way. And then same day, you could start investing in the stock market. So follow us on Facebook, follow us on Instagram. We're always available for direct questions with any concerns or questions you may have, because our goal is to make you feel confident with your money.
Yeah, it's time to stop being scared. It's time to finally pull that trigger and start investing in yourself and investing in your future.
Absolutely. Nobody could go wrong having a better nest egg for themselves. So thank you for tuning in.
Yeah, thanks for watching.